Joining us right now, top economist, MacroMavens President Stephanie Pomboy is here. Stephanie, great to see you.
Thanks for having me.
Thank you so much for joining us. What are your expectations for jobs? You've been so right on this economy in terms of that it's so slow moving, and you're looking at different things than the typical economist looks at. That's why we love getting your insights here. So what's your take?
Well, I guess I wouldn't dispute as ever with, you know, sort of the $185,000, $200,000, woohoo, 200,000 jobs number. It's impossible to forecast month to month, but generally the trend has been decelerating. You know, employment growth peaked in 2015 alongside GDP growth and personal consumption expenditures. So the problem has been that the economy has been kind of steadily losing altitude, and obviously the hope is that we get some tax cuts and, you know, lift the burden of regulation and get things moving again.
Is that the only thing that can loosen things up right now, the policy coming out of Washington?
Well, I mean, for hiring, you can, you know, incent people with reduced regulations, and et cetera, as much as you want. But until demand picks up, why are they going to hire and expand? They need to be able to sell whatever new merchandise they're going to create. And the consumer's been so sluggish that there hasn't been any motivation for them to do that. So we need to hand consumers more income with which to spend. And, you know, as strong as the headline employment numbers have been, wage growth has been really subpar. And as we've talked about many times over, the personal income tax receipt data is telling you that income growth isn't there. In fact, personal income tax receipts are actually negative year on year. So we've got a real mismatch.
I'm so excited to hear, because we hear about this 3% GDP growth, 4% GDP growth. We've had Fed governors here on the show talking about how, you know, the auto industry would really impact that number. What would it take actually to get to a 3%, 4% GDP? Because I'm hearing it out of the administration, but I'm not seeing what's actually going to move the needle. Right.
Well, obviously the big mover would be personal consumption. And you saw the number in the first quarter, revised up to 0.6. You know, that's not getting us anywhere close. And what you're seeing now that's really troubling to me is that it's not just a slowdown in consumer spending, but delinquencies are going up. So we're really so late in this cycle. The consumer needs help urgently, and Washington is busy, you know, arguing with itself, and we need to get some kind of tax reform implemented right away. We've seen an uptick in delinquencies. Obviously, student loans have been a problem for a long time, and subprime autos, but now credit cards and even first mortgages are starting.
But also the credit of the consumer is highest than it's been since the recession, so that report came out this week.
Right, and I think what's happening is that consumers are being forced to borrow more out of distress. Obviously, you know, if retail sales growth isn't accelerating but credit card borrowing is, you know, that's a pretty bad sign. Usually, if they're ramping up their credit cards, they're spending more on vacations and at Neiman Marcus.
You said that even first mortgage delinquencies are going up.
Yeah.
What does that mean, though, for the housing market, which has been kind of an important engine, certainly, in the economy?
That's been a bright spot in this whole picture. Well, in sort of the broad sweep of things, bank lending has slowed dramatically in the last 9 months. It actually started slowing before the election, so a lot of people like to point to that as sort of a Trump effect, which it's not. It was, you know, well into a slowdown before that. But to the extent credit is the fuel of this economy, the deceleration of bank lending actually, at its current level, already presages a recession. So again, we need something to reverse these gears urgently, and I think the only thing that can do that would be some major fiscal reform.
Where do you see growth, if anywhere? I mean, you said, you know, obviously income is down, consumers don't have the wherewithal to keep things vibrant by buying things. So where is there growth right now?
Well, housing, as Dagan mentioned, had been a bright spot. Autos had been, but that cycle has clearly turned. As we saw yesterday, we continue to kind of work lower. And, you know, I would be optimistic about CapEx were consumption accelerating and creating the incentive for corporations to increase hiring and capital expenditure. But
or if we get policy and lower taxes, then we could see CapEx.
Right.
Yeah, I think, you know, this climate accord is just another one of these efforts to reduce the stranglehold of regulation, which is very positive. But again, until end demand picks up, you know, not having to deal with a lot of red tape is wonderful, but you're not going to increase production unless you think you can sell more merchandise.
It makes a lot of sense. Stephanie, thank you so much. Great insights, as always. Stephanie Pomboy, President MacroMavens. Stick